You do everything you are supposed to do. You work hard, follow the advice, and try to stay responsible. Then, right when you need help the most, the bank says no. Most financial advice online is built for people banks already love. Perfect credit, stable salaries, and savings accounts that make lenders feel safe. This is for everyone else. The people who know 2 a.m. cash advances, easy approval loans, and emergency money panic. Because sometimes the smartest money move is not what the gurus tell you. When you are inside the crisis, money looks different. If you feel locked out of the normal financial system, you are not imagining it. The system is a machine built to measure risk. If you have a thin credit file, irregular income, or one old mistake, the machine may flag you as risky. That does not mean you are bad with money. It means the system was not built for how many working people actually live. Imagine Sarah. She works a steady warehouse job, pays her bills, and still lives paycheck to paycheck. One morning, her 10-year-old car starts clanking. The mechanic says the repair is $600. No car means no job. No job means no rent. So Sarah walks into the same bank where she has deposited her paycheck for 5 years. She applies for a small loan and waits with shame sitting in her stomach. A day later, the answer comes back. The bank cannot approve her application. No real path forward. No practical alternative. Just no. That rejection creates panic and shame. Later that night, Sarah is stressed and scrolling on her phone. Then she sees the ad, unexpected expense, quick cash, easy approval, money by tomorrow. It feels like a lifeline. It feels like someone finally said yes. But this is the front door to another financial world, a world that says yes for a staggering price. Sarah clicks. The application takes 5 minutes. Name, address, bank information, and a progress bar. An hour later, her phone buzzes. Approved for $500. The relief is so big she feels like she can breathe again. But this is where we audit the system, not the person. The trap is not just the loan. The trap is the terms. First, they may not lead with the phrase interest rate. They talk about fees. Sarah sees a $75 fee on a $500 loan. In panic mode, that sounds simple. Borrow $500, pay back $575. But translate that fee into annual percentage rate, and the story changes. A $75 fee on a 2-week $500 loan is roughly a 391% APR. That fee is not just the price of the loan. It can become the first payment in a debt cycle. The second trap is the deadline. All $575 is due in 14 days, right on her next payday. The same missing cushion that caused the crisis is supposed to magically appear in 2 weeks, on top of every other bill. That is not an accident. CFPB research found that more than 80% of payday loans are rolled over or renewed within 2 weeks. When Sarah cannot find the extra money, the lender offers a friendly solution. Pay the $75 fee and roll it over. That is the moment the trap snaps shut. Sarah pays the fee, but she has not paid down the original $500 at all. 2 weeks later, another fee is due, and the original debt is still sitting there. Now she is not paying off the debt. She is paying to stay in debt. That $500 car repair can start costing hundreds more in fees. So what does a smart money move look like from inside this trap? Mainstream advice like build a 6-month emergency fund is not useful in the middle of a crisis. The advice has to fit the emergency. Inside move number 1, stop the bleeding. The top priority is breaking the payday loan cycle before it renews again. This is not about skipping lattes. This is emergency financial triage. Scrape together the full repayment amount before the next due date if you possibly can. That may mean selling unused electronics, taking extra shifts, returning non-essentials, or asking family for help. The short-term pain can be smaller than months of paying fees without reducing the balance. Inside move number 2, know the alternatives before the last resort. First, check federal credit unions for payday alternative loans, also called PALs. They are designed as lower-cost alternatives with guardrails. Second, consider a secured credit card when the goal is rebuilding credit. With a secured card, you make a deposit, use a small limit responsibly, and build payment history over time. Third, cash advance apps or employer advance programs may be cheaper, but they still need caution. Fees, timing, and repayment structures vary. Cheap-looking help can still become expensive. Inside move number 3. Use a get-by budget. Forget the perfect 503020 budget when you are in survival mode. Your budget has only the essentials: housing, basic groceries, utilities, transportation to work, and attacking the high-cost debt. Everything else goes on pause temporarily. This is not a forever budget, it is a tourniquet. So what happens to Sarah? In this version of the story, she breaks the cycle. She sells an old tablet, picks up extra shifts, throws every dollar at the loan, and pays off the $575. Sarah is not suddenly rich, but for the first time she is not paying a 391% APR just to exist. Now she has a small patch of solid ground. She can look into a credit union, a secured card, and a tiny emergency fund. When you are outside the system looking in, the first smart money move is not getting rich. The first goal is choice.